And we are now on chapter 11, Home Office, Branch and Agency Accounting. So this chapter deals with businesses that expand their operations geographically but still operate under a centralized structure. So you will learn how to account for these separate but connected entities. For the learning competencies, you are expected to know how to account for transactions between a home office and a branch, reconcile the inter-office accounts, and then prepare combined financial statements of a home office and its a branch. So first, we must clearly differentiate between an agency and a branch. So they serve similar purposes, which is to extend the business, okay, of the home office. But their accounting treatment is vastly different. So when we say sales agency, this is simply a liaison office, and its primary job is to display samples, take customer orders, and sometimes hold limited inventory for immediate needs. So crucially, an agency does not function as a separate business unit. It does not carry its own accounting books. In contrast with a branch is a full business unit, and it carries inventory, grants credit, collects cash, and often operates under the home office name, but with significant independence. So the key difference is that a branch maintains its own records and prepares its own financial statements. So accounting for an agency. So because an agency does not maintain its own separate set of accounting books, all of its transactions are recorded directly in the books of the home office. So think of an agency as an extension of the home office, like petty cash system. So the agency may keep a simple record, perhaps a logbook, to track its cash receipts and cash disbursement. Therefore, to account for an agency, we simply record all agency-related revenues, expenses, assets, and liabilities as if they occurred at the home office itself. While accounting for a branch is more complex because it is accounted for as a separate business unit. So the branch maintains its own records and prepare its own financial statements. However, for external reporting, like for example, reporting to the public, reporting to the BIR, reporting to the shareholders, the branch financial statements must be combined with the home office financial statement. So the core of branch accounting lies in managing the reciprocal accounts. So these accounts ensure that the books of the home office and the branch office always mirror each other's intercompany transactions. So we have two reciprocal accounts. Number one is the investment in branch account or branch current account. This is maintained by the home office to account for its investments in the branch. While we have home office account or home office current account, and this is maintained by the branch to account for the investment received from the home office. So these two accounts should be theoretically have equal but opposite balances at all times, reflecting the same underlying intercompany transactions such as cash transfers or shipments of merchandise. So in the home office books, so let's see how these transactions are recorded. When the home office sends cash to the branch, the home office sees it as an increase in its investment in the branch. Okay? So let's say for example, uh, that's the case. Then the home office will have an entry to debit investment in branch, that is the asset account, and then a credit to cash or merchandise. So this investment in branch account is an asset account on the home office books. And then on the branch books, the branch will record the mirror image. So when it receives the cash from the home office, it sees it as an increase in the accountability to the home office. So the branch will debit cash or merchandise, which is the asset received, and the credit to the home office account. So the home office account is a liability or equity account on the branch books representing the home office capital contribution. So remember, any transaction between the two entities affects both reciprocal accounts. So let's proceed to the combined financial statements. So as mentioned, for external reporting, the home office and its branch are viewed as a single reporting entity, and we must combine their results. So combined financial statements are prepared in two simple steps. Number one, adding together similar items of assets, liabilities, income, and expense. And then number two, eliminating the reciprocal accounts. So why we eliminate the reciprocal accounts? Because intercompany balances are not true assets or liabilities to external parties, as you cannot owe money to yourself. So eliminating these internal balances give a true single entity view of the organization. Now we have shipments to branch billed above cost. So this is perhaps the most advanced topic in the branch accounting. So often, the home office will bill shipments to the branch at an amount above cost, sometimes called the billed price. So why do they do this? They do this usually to prevent the branch manager from knowing the true cost of the goods, thus controlling profit information. So what happens? Upon receipt, the branch records the merchandise at the billed price rather than at cost because they don't know the actual cost. However, when preparing the combined financial statements, all amounts must be reported at their actual cost. Therefore, we must eliminate the markup on the shipments. This restatement is necessary to bring the cost of the goods sold and the ending inventory of the branch back to their original cost. So this markup is typically tracked in a separate home office account like allowance for overvaluation. Okay, and this account is eliminated against the relevant inventory and cost of goods sold accounts during the combining process. So to conclude chapter 11, as a key takeaways, so an agency is simply an arm of the home office. Its records are centralized, while a branch is a separate entity that keeps its own books. So the relationship is managed using reciprocal accounts, investment in branch and home office account, and we combine the financial statements by adding figures and eliminating those reciprocal accounts, ensuring all inventory is reported at the actual cost.